I'm doing this video with a heavy heart. So Lendlease REIT released its full FY2023 results on 7 August, and it was not all rainbows and sunshine. So in this video, I will be sharing my key takeaways from its FY2023 results, and also I'll be sharing my thoughts as a unit holder at the end of the video. So yeah, let's dive right into it. Let's start the good stuff first. So with a full year contribution from GEM, Lendlease REIT experienced enormous positive growth on its top and bottom line. Gross revenue increased by 101.5%, achieving a compounded annual growth rate of 54.5%. Next up, net property income increased by 103.9%, achieving a compounded annual growth rate of 56.3%. Lastly, distributable income to unit holders increased by 51.3%, achieving a compounded annual growth rate of 44.8%. In terms of revenue diversification, GEM now contributes around 61% of Lendlease REIT's total gross revenue, with 313 at Somerset contributing 27% and Sky Complex in Milan contributing 12%. Furthermore, Lendlease REIT's revenue is now much more resilient, with 61% of revenue coming from suburban retail/office as compared to 53.1% of revenue coming from prime retail in the previous year. There was also strong performance for Lendlease REIT in terms of occupancy and lease renewals. Committed occupancy rate for FY2023 came in at 99.9% as compared to 99.8% the previous year. This was partly due to 100% occupancy of GEM, despite a slight drop in occupancy for 300 at Somerset from 99.9% the previous year to 99% in FY2023. Additionally, Lendlease REIT also recorded positive retail rental reversion of 4.8% and rental escalation of 5.9% for Sky Complex in Milan. This was an increase from the rental reversion of 3.6% recorded in FY2022. In terms of this expiry profile, Lendlease REIT has around 10.6% of gross rental income up for renewal in FY2024. In total, 30.9% of Lendlease REIT's gross rental income will up for renewal in the next 2 financial years. So, that's about all the good stuff for Lendlease REIT's results. Let's now move on to not so good parts about the result. The most obvious thing is that DPU fell by 3.2% as compared to the previous year. Management attributed the fall to higher finance costs due to the high interest rate environment. If you look at the financial statements, this bears truth as finance costs have ballooned around 220% as compared to the previous year. To understand why the increase was so significant for Lendlease REIT, we have to look into its debt profile. As of June 2023, only 61% of Lendlease REIT's debt is hedged to fixed rates. This means that 39% of total debt is subjected to the prevailing interest rate environment. So since we've been pretty much in a high interest rate environment since Q3 of 2022, Lendlease REIT's finance costs have thus naturally also increased. This also explains the 100 basis points jump of Lendlease REIT's average debt from 1.69% in FY2022 to 2.69% per annum in FY2023. Additionally, I also feel the acquisition of GEM had a part to play in the DPU reduction. If you look back at the acquisition of GEM, it was done via 3 phases: in October 2020, August 2021, and finally April 2022. In total, Lendlease REIT used around 1.35 billion in debt, 648 million from equity fundraising, and 400 million in perpetual securities to fund the acquisition. With this huge amount of debt and an enlarged unit base, I personally felt it contributed to the fall in DPU, on top of just the high interest rate environment. Adding on to the fall in DPU, Lendlease REIT financial health also took a drastic hit in FY2023. Its aggregate leverage percentage rise to 40.6% in FY2023 as compared to 40% in the previous year. If the perpetual securities were taken into account, Lendlease REIT's aggregate leverage percentage would be at 51% instead. More worryingly, its interest coverage ratio for its debt agreements fell to 4.2 times in FY2023 as compared to 9.2 times in the previous year. Adjusted interest coverage ratio also fell to 2 times in FY2023 as compared to 2.7 times the previous year. This has significant ramifications for Lendlease REIT in its growth plans. As per MAS regulation, the 50% gearing limit is subjected to REITs having an adjusted interest coverage ratio of at least 2.5 times. As Lendlease REIT's adjusted interest coverage ratio was 2 times, its gearing limit would be at 45% instead. This signifies that Lendlease REIT only has a debt headroom of 168.3 million before hitting this 45% limit. On the bright side, Lendlease REIT does not have any debt refinancing needs until FY2025. Its average debt tenure also increased to 3.4 years post-refinancing. So having gone through Lendlease REIT's FY2023 results, what's next for the REIT moving forth? DPU-wise, I feel that much would depend on the performance of GEM, and to a lesser extent, 313 at Somerset. The annual rental escalation of the Sky Complex in Milan could also provide incremental upside to DPU. Additionally, the multi-functional event space at 313 at Somerset could also provide further upside to Lendlease DPU. However, as of 10 August 2023, construction for the event space is expected to start, and management also estimate that the full construction phase will take around 12 to 18 months for it to be completed. Furthermore, there's also a need to account for another few months for tenants to move in before the event space can provide DPU upside to Lendlease REIT. Also, if you did not know, Lendlease REIT recently acquired a small stake in Parkway Parade. If the acquisition of GEM was anything to go by, this recent acquisition of a small stake in Parkway Parade could lead to further incremental stakes before finally accumulating in the 100% purchase of Parkway Parade. In terms of finance costs, it should start decreasing once interest rates start going down. However, it's very hard to predict when this will exactly happen. So if it does happen this year, take it as an upside bonus to Lendlease REIT's DPU. So after going through Lendlease REIT's entire FY2023 results and its growth prospects, as a current unit holder of Lendlease REIT, I'll personally be selling my entire stake in the REIT. Reason being, I feel that the REIT will not be able to grow without being dilutive to unit holders. If you consider Lendlease REIT's recent acquisition of effectively 7.7% of Parkway Parade from Parkway Parade Partnership Private Limited or PPP for $90.5 million, it will mean that there will be a balance of around $1.085 billion for the full acquisition of Parkway Parade. However, we need to be aware that the PPP is a wholly owned subsidiary under the Lendlease Group. Currently, PPP owns around 77.09% of the shares of Parkway Parade. This means that the other 22.9% of shares are owned by other vendors that have no link to Lendlease Group. This could result in a higher acquisition price, as these independent vendors will most likely demand a higher price for their shares. Given Lendlease REIT's current low unit price over the past few years, if an equity fundraising was to take place, they were to issue a large number of units, which could result in a dilutive effect on current unit holders. To partially mitigate that, Lendlease REIT could also issue out perpetual securities once again under its $1 billion multi-currency debt insurance program. Currently, with $400 million used during the acquisition of GEM, there's still a balance of $600 million left for Lendlease REIT to utilize. However, judging from the previous issuance of the Series 2 perpetual securities at 5.25% per annum and the generally overpriced acquisition of GEM, I am not confident that the management can fund future acquisitions of Parkway Parade in a way that won't be detrimental to unit holders in the long run. Thus, this leads to my decision to sell my entire stake in Lendlease REIT. My targeted selling price would be at around 68.5 cents, and if dividends and trading commissions are taken into account, it will result in a profit of around $463.28, or about a 2.6% gain. At the end of the day, I feel that Lendlease REIT has really good properties in its portfolio. But for it to do well, the management of the REIT also has to step up to the plate. And for me, Lendlease REIT management wanted to prove to me that they can do that. Do you also invest in Lendlease REIT? Let me know what you think of the FY2023 results in the comments below. If not, I will see you on the next video. Goodbye.